Hey guys, Akil Stokes here. Welcome back to another episode of the Trading Coach Podcast. Got another video episode for you, so tune into the Spotify or the YouTube to check it out. I apologize in advance. I'm lagging a little bit right now as we have some storms going on outside, but hopefully it gets better. But I was recently reached out to by a trader on social media who had a handful of questions. It was a newer trader who was very confused and struggling, and pretty much I was getting question after question after question. How should I trade? What should I trade? Should I do this? They say that. And before this trader's head literally exploded, right? I came in, saved the day, and said, hey, relax. I got you. A lot of questions, a lot of concerns. How about you let me record a podcast episode for you? That way we can clear up all of this confusion and help you get on the right track. And knowing that this trader isn't alone, as many of you probably have the same concerns, well, this is going to help you as well. Now, I'm not helping you for free. I want something in return. It's not your money, don't worry. I want you to, one, like this podcast, wherever you're listening or watching this at. 2, subscribe to the YouTube channel if you're over there, or follow the podcast if you're listening to this on a podcasting app. And 3, leave me a rating and review if you think any of these thousands of episodes that I've done are valuable. All right, so let's hop in and let's talk about how to ignore the noise and really lock in on the things that matter about trading. And I want to start off by reading you some of the questions that the trader asked me. So our trader starts off by saying, man, I've been watching you and Jason for months and studying everything you say. I signed up for the 30-day challenge and working my way through. I've been getting hit by over 50 ads per day from traders, trading communities, gurus, etc., all offering amazing packages to become a professional trader. Nearly all of them are contradicting each other on the methods, strategies, and time it takes to learn, trade plans, and offering backtesting, etc., etc. I'm so confused which way to go and have a million questions. So let's start with that first question of ignoring the noise. We live in a very interesting time, and it's really a gift and a curse, right? Technology has allowed us to have access to more information than ever before. You can literally research and find anything on the internet, whether it's trading specific or just anything in the world, right? If I want to do something, I find a YouTube video of it and I learned how to fix it in the house. It's that simple. So it's cool that we have access to all this information. If I want to learn the head and shoulders pattern, I can find it. If I want to learn what a triangle is, I can find it. If I want to learn about leverage, I can find it. We also have access to many of our mentors or people that we look up to in the industry, which has never happened before, or at least was a lot harder before. You know, many of the greatest traders in the world are out there on social media sharing their ideas. They're out there on YouTube doing videos like this, or have podcasts, or many of them even answer DMs if you have questions, because we're, at least the good ones, are interested in giving back, since at some point someone gave back to us to help us get to where we are now. And it's cool to have that type of access, because before you would literally have to get in your car and travel to specific places to find these people. With that being said, there's also a curse, because for every one of those goods, there's probably 99 of those bads. And what I mean by the bads are people trying to scam you, trying to trick you for whatever reason, trying to get money or just personal ego, or maybe they just get a laugh out of seeing people fail. Believe it or not, there's people out there like that. And it was the same way when I first started trading, and perhaps maybe even worse, right? So when I first started trading, Forex was pretty much brand new. It was the gold rush of Forex. Forex was this big, new, popular thing. It finally became available to retail traders in the late 90s, early 2000s. And, well, everyone thought it was the next big get-rich-quick scheme. It was very similar to what crypto was when crypto first came out and everyone went bonkers. Forex was like that because of the amount that it was leveraged. And there was everyone everywhere trying to sell you and trick you. And I never fell victim for that. I did fall victim to a scammy broker, a broker that stole all my money, and so did a lot of other people. But that's a different, more complicated situation than like buying a course or a signal service or whatever they're trying to sell you now. But I never fell victim to any of that stuff because of 2 reasons. One, I'm extremely paranoid, so I don't trust anything, right? I barely trust myself. 2, I've always learned that if something sounds too good to be true, it probably is too good to be true. So I know exactly how hard trading is. I know how hard investing is. I know the rates. I know that 90% of traders fail. So if someone is selling me something that's making it seem very easy for me to progress, it's probably a trick. Some bits of advice that I have for you, along from, again, if it sounds too good to be true, run away as quickly as possible, is to do your research. If someone says like, hey, I can make you blank amount a year, I'm going to share a few kind of a social media scam later that provides the exact warning signs that I'm talking about. Do some research, look around the industry and ask, what is a proper expectation from this? What is a proper expectation from that? And if what they're saying doesn't align with kind of what the rest of your research says, it's probably a sign that they're lying to you. Now, the next part said nearly every one of these gurus, communities, traders, coaches, whatever it may be, they all have they're all contradicting each other as far as method, strategy, time it takes to learn, trade plans, et cetera, et cetera. And this one is kind of yes and no, right? So let's start with contradictions of methods and strategies. We'll focus on that one. That is normal, but there is a wrong and a right way to go about it. So why is it normal? It is normal because there isn't just one way to be successful. There isn't one strategy, one market, one whatever that will give you success. It could be done in various different ways. I did a podcast on this, maybe a few weeks ago called, I think it was 4 Lessons I've Learned from Market Wizards. And again, one of the best lessons that I learned from Market Wizards is that you can do it any way. All of the traders in those Market Wizards series achieved massive success doing it in a different style. You could be fundamental, you could be technical, you could be trend, you could be counter trend, you could be pattern, you could be indicator based. It doesn't matter. The true predictor of success is you, the person, right? The holy grail trading lies between the 6 inches between your ears, right? It is your brain and your ability to find something that works and then not mess it up. So yes, you're going to see some contradictions out there where trader A may say, hey, mechanical system, that's the way to go. This is how you be profitable. And trader B may say, Fibonacci, that may be the way to be profitable. And trader C may say, astrology, get yourself an almanac and a telescope, and that's the way to be profitable. And all of them could be right. The biggest red flag that I see from, again, your traders, gurus, people out there in internet land is if they tell you that you can't be profitable doing X, Y, Z. There's one thing that I've learned from my experience working with kind of the best traders in industry, which I'm fortunate to have that ability to do so. And it's that they will never tell you that what you're doing is wrong, meaning that as far as your method, right? They will never tell you that you can't be successful being a trend trader. You can't be successful being a pattern trader. You can't be successful being this. You can't be successful being that. Usually the message is find out how you can be successful. And if you've exhausted all ability to do so, then obviously that strategy is not a successful strategy and you may want to find something else. But if they're going to say anything, it's going to be you can't be successful without a rules-based trading plan. You can't be successful without proper risk and money management tools. You can't be successful without using a stop loss, for example, right? You can't be successful without treating your trading like a business, right? These are foundational principles that you can't be successful with, and these are 100% true. But as far as the specifics of your trading strategy, you could do whatever you want in reason, as long as you backtest it and make sure the numbers come back profitable. There we go. I think I got all of that out the way. So I'll go ahead and read you more of the question. I'm absolutely dedicated to being a professional and running this as my long-term business. I'm already doing 4 hours of training per day for 6 weeks. Well done. That's a lot more than most out there. I really don't know which direction to turn next. It's like the industry offers 2 ways. One, there's a long 3 to 5 year period before becoming pro. 2, learn the basics in a few weeks, a few months, stick to a simple plan, and then be consistent. Which is correct? The industry wants to confuse us so much. I just want simple and clear instructions. Again, the reason the industry wants to confuse you is because many people out there don't have your best interests in mind. They're just trying to tell you whatever you want to hear so that they can sell you whatever they want to sell you. But I would say this. At this point in your trading, as you're new, I wouldn't even worry about how long it's going to take, because there's no way you can possibly answer that. Now, I'm all for having goals. I think you should set goals. I would like to be a professional trader. I would like to be a full-time trader. I would like to be a part-time trader. I would like to trade live by this, by then. But understand that that goal, that journey to your goal is going to be fluid because there's so many things that we don't know. The time frame for learning how to trade is going to be different depending on the person. Like, what is your entry status? Are you brand new to trading and know absolutely nothing? Do we need to start the very basics? Like, what is a pip? What is a tick? What is a line chart? Are you someone that has a little bit of knowledge? Are you someone that has a lot of knowledge, but maybe a lot of bad habits that need to be broken? How fast do you learn? In general, we all learn at different rates. How much time can you dedicate to learning? The more time you can dedicate to learning, the quicker you're going to progress. What strategy are you going to approach? Based on that strategy, how long is it going to take you to backtest, right? There's so many answers that we just don't have right now that we can't make a proper prediction. So my advice is this. Have that long-term goal, write it down, what you want to do, even attach something time-based to it. That way, you're not just kind of, treading water forever, because that's something else that can happen. But understand it's going to be fluid. I think once you get to the point where you've learned how to trade, you've picked and developed a strategy, and you're at the backtesting portion, that's when you can start getting specific with these goals. Because as you're backtesting, you can set aside how long it's going to take you to backtest. You can set aside how long you want a paper/demo trade for. You can set aside how much time you're going to spend progressing through each moment of your live trading as far as like kind of scaling yourself into your full allotment of capital. You'll also by then have the backtesting results. And what those backtesting results will do is they'll tell you what you can realistically expect from your trading strategy, right? Before you backtest, you have no idea what you can make, right? You can sit back and be like, I'm going to have a strategy that makes 60% return on investment a year, but you don't actually know that, right? You can say it, but it doesn't mean it's going to happen. Once you have a strategy, once you've tested it, once you've played around with your risk management and position sizing tools, you can have a realistic expectation of, if I do this without error, now between me and you, you're going to make some errors, so always kind of shoot below what those backtesting marks tell you, right? But if you execute without error, then you should be able to produce this much. Then based on how much you produce, you can look at how much capital you have, which is also going to be different from person to person. And then you can calculate how much money or how much time it will take you to get to the amount of capital that you need to trade full time or sustain your life or a portion of your life off your trading. And again, that's also going to be different per person because we all live in different areas. It all takes a different amount of capital to live comfortably, I guess you can say, on a daily basis. For example, if you live in New York City and you're making $100,000 a year, you're probably going to be poor. You can't afford to, live in New York at that much. Versus if you live somewhere in the Midwest somewhere where there's nothing around, you can probably live very, very, very good off $100,000 a year because the prices of living are just so much lower. So that does play a big role too. So to touch on the question the trader asked, specifically going to backtesting, he said, I saw a video yesterday where Jason was showing an AI website that does all the backtesting for you in seconds. But in our training, it says we need to manually backtest for months in order to gather that data. So what is right? And again, both is right. It depends on what you're trading. If you're trading a mechanical system, let's say you're trading a strategy based off of moving average crosses and the stochastics K hooking over to D, right? Then you can easily automate that, backtest it, because there's no subjectivity, there's no discretion. It's black or white. There's no kind of human element to kind of finding opportunity. So a mechanical backtest is perfect for that. However, if you are a discretionary trader, if you are the one in the market reading the price chart, analyzing the opportunities, then you should probably backtest manually because you need to train your eyes to see what it is you will be seeing live. There's also another component where maybe not trading specifically, but there's like seasonality and stuff like that with backtesting as well that an AI can help you with. So you can have your backtesting already and then implement that seasonality form into the backtesting results and then see how that aligns with kind of the results that you're getting. Where it's like, oh man, my results sucked from June to July, and then you can see a trend of that as well. So AI can help either one, but specifically if you're going to be a discretionary trader, right, you should be doing manual backtesting because those are the reps that you're going to need impact and develop your RAS, your reticular activating system, in the markets. Now, one last question. I'm going to kind of find two parts of this before we get into the scammy stuff. He said, it'll be interesting to know if you guys tried all the pairs, lots of different strategies, and took years before deciding to go live with your chosen plan. And then later on, he says, how many strategies, how long will it take me, and should I only test major pairs? So for one of those questions, I'm just going to refer you, instead of making it a whole new podcast off of it, I'm going to refer you back to a recent podcast that we did, episode 1205. It's called Treat Your Trading Like a Business, Start, Grow, Small, Big. Small, big. Start small, grow big. There we go. Haven't had the coffee yet. But this podcast specifically talks about the journey that you go into when it comes to growing your trading like a business, meaning, starting with a simple strategy and then backtesting that strategy, live trading that strategy, and then building your strategies from there. So instead of making this another 20-minute podcast on that topic, I recommend going back and again, listen to episode 1205, the Trading Coach podcast. But also to touch on the pairs thing, I think another myth out there is that major pairs are better than minor pairs. I kind of spoke about this in the Dollar Swiss Black Swan podcast, but the major pairs have more intervention, which means less of a natural flow. So for many traders, they actually find more success trading the minor pairs because there's less randomness, there's less weird trump grenades that get thrown into the market. So don't assume that the major pairs are going to be better than the minor pairs, and don't just say, hey, I'm only going to test with them. Or our trader went on to say some stuff, if I can find it here. Sorry, I closed my thing down. Where are you at? Not sure if I can handle 4 just yet. I want to start with 2, like the euro dollar, which again is the most popular pair. But I would encourage you not to assume that it's the best pair, because that's probably not the case. But they're not. He said he's not sure about a second pair. He likes the yen, but only because I see Jason trading it. So he likes the yen, but only because he sees someone else trading it. He says I obviously don't want any correlation issues, which is another topic for another podcast. However, I am based in the UK, so would that work for me? Doing pound yen, is that a good pair? Should I stay clear? Right? All this confusion and randomness that is going through this trader's mind. And the solution to this is simple. When you test all the pairs. Right? Unless there are specific pairs that you won't trade because of the spread or a personal vendetta like me in the Swiss, just test them all. And that's the cool thing about having these numbers. If you test 20 pairs, right, you can then go through them and literally see which are the best pairs for you. You don't need to guess. You don't need to say, I think euro dollar is going to be the best because of this. I think yen's going to be good because I saw Akil and Jason trading it. No, you don't need to think. Thinking is bad, right? Thinking is just assumptions with no stats to back it up. We want hard data to tell us which is better. And if someone asks us, hey, why is the euro dollar better for you than the pound dollar? You say, bam, look at that. You probably don't have your back testing on an actual sheet of paper, but you can grab a monitor. Bam, look at this. There's a spider web flying in my mouth. That's horrible. Oh gosh, I'm gonna keep it in because you guys find this funny. But yeah, this is why I don't do props. Hopefully that's cleaned up now. But yeah, and for you guys on the audio version, I found a random monitor on the ground and lifted it up in front of the screen, and there was a spider web that flew into my mouth, and it was very awkward. Luckily, there was no spider in there, or I might have gotten superpowers. Trying the Spider-Man thing, it's not working. Anyway, still normal human. Anyway, so that's the data that you need. Now, to end things, the trader shared with me an example of the kind of stuff that's getting him confused, like one of the 50 million ads that he's being bombarded with on a daily basis. And I want to share it with you and just bring up some red flags. I'm going to kind of blurb out the name because I don't want to... I never want to call anyone a scam, even if it's an obvious scam. It's none of my business. But this is the type of stuff that you hear out there.
They have a trading strategy that makes it possible to have a win rate of 85% with a minimum risk ratio of 1 to 4 per trade. The combination of these two ensures that you are guaranteed to earn money. The results were beyond my expectations. It felt like I'd unlocked a hidden vault of trading success. Just take a look at these stunning results. This isn't just luck, it's a proven system. Best of all, they have a trading bot that copies all of their trades to your trading account, and their track record is impressive. Don't miss this chance to learn from the best. Trust me, whether you're new to trading or looking to elevate your skills, it can be a game changer for you.
And again, I'm not saying this is wrong, but I am saying either run as far away from possible if you think it sounds too good to be true, or just do your research. Some things that would have personally stood out for me would be the 85% hit rate. That is a very high hit rate. Understand that most professional traders are hitting anywhere between 40 and 60%. So when you hear something like 85, that's a big jump between kind of what the norm is for, the best traders alive. You add to that, it's an 85% hit rate with a 4-to-1 risk reward. So typically things work like this. The greater your risk reward, meaning that when you win a lot more than what you lose on a trade, your win rate tends to be lower. We see this with like the turtle traders like Richard Dennis, where their risk reward is amazing, but they only won at like a 20% clip. So they lost a lot, but when they did win, right, they won a lot more. Vice versa, when you see traders have a very high win rate, like 85%, you typically see a much smaller risk reward, or even an inverse risk reward, because they're just trying to get the money out the market quick. But when they lose, they're allowing themselves to have more room to lose. But when they lose bigger. So that's kind of a rule of thumb. The higher your win rate, usually the smaller your risk reward. The lower your win rate, or the higher your risk reward, usually the smaller your win rate. So to have both a very high win rate and a very high risk reward, that's a little red flaggy. But the biggest red flag, I wish I had another prop, a really big red flag to hold for you. I usually have an America flag back there. It's somewhere up there. Is when they showed the screen grab of the signals and it was all profitable except for one. That is not realistic. And I can tell you what these guys do, right? When they do stuff like that, pretty much what they are doing is they're taking multiple positions on multiple accounts, right? So it's not necessarily false. They're not necessarily like photoshopping in results to be false. These are real results. But what they're doing is if they have 20 accounts and they're taking multiple positions in different directions of different pairs, eventually you are going to get some trades that win, because that's just how it works if you hedge the market in all directions. And what they're doing is they're picking out the grouping of ones that look great and showing it to you. I invented a strategy called the DKC, right? It was a great strategy that was very, very horrible, and that's why I don't trade it live, nor do I recommend it to any of the traders. But it was a very streaky strategy. So what I mean by that, it was a very profitable strategy, but it had a very low win rate, right? The win rate was like 30%, maybe 35% at the highest. The problem was it was very streaky. So it would have these hot streaks where I would win like 8 trades in a row, but then there would be cold streaks where it would literally lose like 20 in a row. And you can see why I don't trade it live. Just psychologically, I'd be all a mess, right? But if I were one of these gurus, for example, what I would simply do is I would look at that 30 trade stretch where I have, let's say, 10 winners and 20 losers. And I would just, and they typically came in bunches. That's just the way the strategy worked, right? I would then just start my screenshot at the first winner and stop my screenshot before the losses came. Maybe I'd throw in one loss just to kind of seem honest, right? Because I can't have 9 out of 10. I can't have 10 straight wins. I got to have 10 out of 11 just to kind of keep it honest. But I would screenshot that one section and then show it to you and be like, hey, this is what my results are. Ignoring the fact that after that, it just fell off a cliff. And this is something called curve fitting. So that's the biggest red flag I see there as well. So hope you guys enjoyed. I apologize for the lagginess. I don't know if it happened, but I can kind of see it in my peripherals that it's happening, and it just makes for bad videos. But I appreciate you hanging with me anyway, because the content was good. Like I said earlier, support the show here. Like, subscribe, lots of cool content on the YouTube channel. Follow the podcast, that way it's in your algorithm and you don't miss the next episode. And until next time, plan your trade, trade your plan. Take care.